Welcome to the Paper Trail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris 70, and after years of buying, managing, and selling notes with 70 investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. Welcome back, everybody, to another episode of the Paper Trail podcast. I am back. We just finished the Paper Trail conference. Great time. Thank everyone that went to the conference. I think a lot of people walked away with a ton of education, which was my goal, to make it more workshop-based, workshop-oriented for people to really dive in and learn. It wasn't somebody up there just pitching a service or teaching you something to do so you could go buy their course. It was relevant, informative, and I hope everyone enjoyed it. And for those that missed it, it was not recorded intentionally. We did not record it so people could speak their mind and really talk about things in an intimate setting, including people asking questions that they might not feel comfortable asking if they were being recorded. So hope people enjoyed the conference. And again, if you did not, wait for some more information about the next year, where we are looking at having it at the same location in Chandler, Arizona, around that same time of year. Other news within 70 Investments is we are in the process of closing our Regulation A+ offering. What does that mean? Because we get a lot of people asking us that question. The SEC requires any Regulation A+ offering, gives them a 3-year window within that offering. And we have come up upon that 3-year window. Actually, we slightly are over that window, but prior to the 3-year mark, we resubmitted for a new Regulation A offering, which allows us to extend our current offering for up to 6 months. We are closing this offering in November. And what that means for investors is those who are investing in our Regulation A+ fund, looking at those bonus shares, those are going to be going away. Your investments will continue to, the company is not going anywhere. All we're doing is creating another path, another avenue to invest in the company and closing out the prior. No different than other offerings. For example, a multifamily or self-storage, they close that offering to new investments and they continue to operate. We are doing the same thing. So we are hosting a webinar in mid-October of 2025 on this. So recommend that you come on and join the webinar. Today, what I want to talk about was an article I was reading in ATTOM, ATTOM and USFN, United States Foreclosure Network, that targeted over towards Mortgage Point, which the title of this was Keeping an Eye on REO Trends. And within our portfolio, we just finished our semi-annual report, and we're looking at our portfolio and how it has changed over the past 6 months and the past year. A year ago, within our portfolio, we had 2 or 3 real estate owned properties. As of June of this year, we're up to 12. So we 4x'd that number. And that number actually has gone up slightly even since that time. Why? Well, what the data is showing is, this data was from August that they took, which was from ATTOM. There were almost 36,000 foreclosures filings, which are defined as sending default notices that schedule auctions or complaints, which was down from July by just 1%. But up almost 20% from a year ago. So a year ago, there was roughly, between 25 and 30,000. Now we're up over 35,000. And some of the facts that stick out with this is August was the 6th consecutive month that we've had year-over-year increases in activity, and this 3rd straight month with double-digit growth. So the last 3 months, they've had double-digit growth in foreclosure. Now, that's essentially the quarter. And it'll be interesting to see what happens the next quarter. And things I look at, for example, when people say, okay, are you in a depression? You in a recession? You know, they look at the past quarter, a few quarters. Where are we headed on defaults? And I always remind people, the mortgage and real estate space is such a slow moving train. What happens years ago is finally starting to take its toll, which is home prices increased significantly. People took a lot of leverage, and we are seeing price declines in many markets. We've also seen taxes increase. We've also seen insurance increase. So let's dive a little bit more into those numbers. Through August, lenders took back 4,000 properties in August. And again, another 5% increase over July, but a 40% increase from a year ago. So a year ago, it was about 2,500 properties. Now it's over 4,000 properties. Where is this happening? This is important. Whether you're a real estate investor, a mortgage note investor, looking to buy a home, because the more REOs there are, the more impact it may have on pricing. Now, you can assume that, you know, the largest states typically have the greatest, which is the case. You got Texas leading the way, California, New York, Florida, and Illinois. Then if you look at MSAs, metropolitan statistical areas, you know, Chicago, New York, Houston, San Antonio, and Dallas. Now, what are some of, now this is where properties were taken back. What are some of the things that you're seeing in some of those metropolitan areas? Very high tax, very high insurance. So there's a theme. To me, there is a theme that areas that have very high cost of ownership, you see more REOs, because if you have newer investors coming in, they don't understand that cost, or even people owning these assets, single, you know, owner occupied. A lot of times when I bought my first house, I was way off on understanding the true cost to own a home. So it's something that considers. Now let's talk about foreclosure rates. Where are you seeing the greatest amount of foreclosures? Leading the way, Nevada, which is interesting because I recall, you know, a little over 15 years ago during, you know, the Great Recession, Nevada and Florida were leading the way. And I don't know if it was just because of the movie The Big Short, where he goes out there and sees the exotic dancer and she talks about like 4 homes or whatever she had. But I remember pricing in Nevada, pricing in Florida, shot up and then got crushed on foreclosures. Second, or right around also increasing, is, and this one surprised me a little bit, South Carolina. Now, South Carolina has, you know, a significant amount. We haven't seen a lot of activity in South Carolina. We've seen some defaults in Nevada. South Carolina, we have one foreclosure actually coming up in South Carolina, but it hasn't been rampant from what we've seen. So that one kind of caught me off guard. Another is Florida. Definitely not surprising. The southwest area of Florida and condos are getting crucified. I just saw a $60 million tape come across my desk. I think 20% of these assets were in Port Charlotte, Cape Coral, Tampa area. You know, that west coast of Florida is getting crushed right now. So if you own property in that area, my recommendation would be most likely to try and stick it out, because it will recover, but that area is taking the proverbial beating at this point in time. The areas that they mentioned: Lakeland, Florida; Columbia, South Carolina; Chico, California; Cleveland. which not surprising. It's an area we no longer do business in because of the jurisdiction is just so challenging. And Ocala, Florida, which we actually have a non-performing loan in Ocala, which is more in the center part of the state. Others areas that they talk about, Las Vegas, not surprising. Jacksonville, again, an area with tons of investors pouring in. Houston and Orlando. Orlando, of course, with a lot of short-term rentals, maybe those getting hit hard. So you're seeing some of these areas that are typically known to have the high boom, high bust. So those areas, again, and they continue just going back to the states. We talked about the REOs, and now the states where foreclosure starts. It's the same. Texas, Florida, California, New York, Illinois. And it's interesting is in Illinois and New York, those will stack up very quickly because it takes a significant amount of time to foreclose in New York and Illinois. Florida, very similar. It takes a little bit of, could take a year to foreclose in Florida. Texas and California, very short foreclosure timelines. California, to the disbelief of many, quick foreclosure. Evictions, a different story. So why do I share this data? What does it mean? What can you do with it? This data continues on that upward trend. And none of us are, no one can predict the future. What I tend to do as an engineer is follow the trends and always go by the philosophy of everything reverts back to some type of mean. And over the years, pricing has increased significantly, interest rates have gone up, and more people have gotten into the real estate space, whether it's to own a property or to own it to live in it or own it as an income producing property. The numbers typically, again, pricing goes up, people come in, FOMO, then you'll see several years later, the defaults start to kick in and they'll continue to rise. I don't think we're going to see anything like 2008 in any way, shape, or form. But what you're going to see is an increase in defaults. You're going to see an increase in foreclosures. And you're going to see opportunity. You'll see opportunity in foreclosure properties. You'll see opportunity in people having to sell even though they have equity. And their carrying costs are significant. So it might be cheaper for them to sell it at a discount. Be many different avenues. And the other thing to consider, real estate is market driven. What happens in Las Vegas may not happen in Boston, may not happen in Northern Virginia, but could happen in Miami, Florida. Things to really focus on and understand. So you want to follow where this is happening. As a note investor, why this is important is I mentioned Port Charlotte. We have 2 non-performing loans, I believe, in Port Charlotte right now. And that area is getting crushed. When we bid on those, 6 months ago, we discounted the value of those properties because at that time, we saw some writing on the wall. If somebody did not discount the value of that property, they could have now overbid and could potentially either make little to no or lose money on that asset. So as a non-performing note investor, it's important to follow these trends to understand where home prices are headed and going. Because you don't know, but in Port Charlotte, if you bought a note today and it takes a year to foreclose, where do you think pricing is going to be in a year? Will it be higher, lower, or the same? If you expect to be higher and bid that way, you're just adding risk. You get no benefit at all for predicting something to be higher. If you predict nothing happens, and prices stay the same, you're taking on the risk prices may go down. If you include some price decline that you've already factored it in, just like stock markets and everyone else factor in whether there's going to be a rate cut or what's going to happen, that can get factored into that pricing. So if it happens, you're okay. If it's less, you win. If it's more, you lose. So it's that balance of figuring out how much you can dictate and adjust with also still being able to win and buy assets. And that is part of the secret sauce of a note investor that nobody teaches you. Everyone just tells you, take a model, throw numbers at it, and it spits out the information. There's a lot more to it than that. It's no different than owning real estate. It's no different than anything you do where you're trying to predict something, because I say this all the time, the moment you put that information into your calculator, it is wrong. So how to make sure that you're taking that into consideration. And I'm going to be doing a 10-part series coming up that shows how to bid on non-performing loans outside of just relying on a calculator, because it's important for people to understand these external factors that are going on. And again, 41% surge in real estate foreclosures. It's still low by any means, but it's starting to see that increase, and it's starting to pick up steam. Also, when they talk about other factors, consumer price index is 3% year over year, for inflation, which I always joke that I never believe those numbers, because I also think it's much higher than what they show. So something to definitely think about, something to consider, is where these are headed. And the other article that actually posted this on LinkedIn that ties to this a little bit is also the number of defaults that aren't even yet in foreclosure. It's just those that are trending now 30, 60, 90 days that are moving the needle. And this was more based off of commercial lending, which, again, very different than residential, but also just something to be very aware of. And in that article, from Q2 of last year to this year, total NPLs increased by $10 billion, which is 5% increase. Commercial real estate was 5.3. Non-farm residential increased by 1.5 billion, which is 4.7% increase. Construction NPLs were $1 billion, multifamily $2.8 billion. So definitely, it's not a tsunami that's coming, but significant increases. For example, commercial NPLs increased by 102%, as compared to with 13% of the entire industry. Non-residential increased by 53%. Construction NPLs increased by 63%. Construction NPLs, 63% construction loans increased. That's not how many are in default. That's how many the percentage increased. Multifamily non-performing loans, listen to this, increased by 426%. 426%. A lot of those are resetting. A lot of them in default. What does all this, why am I here? Why am I talking? If you're an NPL investor, opportunity is going to be knocking. Be prepared. You're going to have the opportunity to invest in defaulted debt. So make sure you understand what it is you're doing. You follow the metrics, and you be patient. I want to thank you for catching this episode of the Paper Trail podcast. As always, make sure to leave us a review on your favorite listening station. And if you want more information about 7E, go to 7einvestments.com, where we have our links to our fund offering to our Regulation A+ offering at the SEC website. We also are now originating DSCR and residential transition loans, which you can learn about at 7einvestmentlending.com. So if you're an investor looking for a loan, whether you're refinancing that rental property or looking to acquire a rental property, we now within our team have the capacity, capability, and relationships with some correspondent lenders to do that. So thank you for listening. Take care, and I'll catch you on the next one. Thanks for joining me on this episode of The Paper Trail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris Seveny, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.